Welcome to the Pro Ticker Deep Dive. So, the Federal Reserve finally did it, pulled the trigger on that quarter-point rate cut.
Yeah, no big surprise there. It was probably the most telegraphed move we've seen in a while.
Exactly. But the real story, the thing we need to unpack for you today, isn't the cut itself. It's the chain reaction.
Mm.
It's about the seismic shift this could trigger in global markets, in capital flows. We've looked at analysis suggesting this single move could really define things for the next year or so.
It really forces everyone to ask that fundamental question, doesn't it? Is this the start of just another classic risk-on rally, money flowing everywhere?
Or is it something different? Are we in uncharted waters here?
Precisely. And right away, there's a critical distinction we have to make, something that changes the whole historical playbook.
You mean the context of this cut?
Exactly. Think about past easing cycles. Often, the Fed only started cutting rates when, well, the house was metaphorically on fire, right? During a crisis, trying to stop a collapse.
Right. Desperate measures for desperate times.
But this time, it's preemptive. Growth has cooled off a bit, sure, but the economy isn't falling apart. It's far from collapse. This is, let's call it strategic easing.
Strategic, not desperate. And that difference, that's the crucial nugget, because it means the old rules for how stocks, gold, emerging markets react, they might not apply.
They probably don't, or at least not in the same way.
So our mission today is to dig into the evidence. What does this strategic non-crisis easing actually mean? We're seeing signs it really tilts the odds towards a weaker U.S. dollar, stronger emerging markets, and maybe, just maybe, a new big push higher for commodities.
Okay, let's start there. A 25 basis point cut. It signals the Fed's officially shifting gears, right? Leaning into supporting growth, maybe less worried about inflation for now.
Yeah, back in easing mode. But why does this type of cut, the non-crisis one, impact global capital flows so specifically? What's the mechanism?
It really boils down to the dollar dynamic. It's fascinating. In a crisis cut, what happens? Fear takes over.
Capital flees to safety.
Right. It floods into the U.S. dollar, into treasuries. The dollar strengthens. U.S. assets look like the only safe haven, and that just sucks liquidity out of everywhere else, especially emerging markets.
Yeah, because if you're, say, Brazil or India, you can't cut your own rates. If the dollar is soaring and U.S. yields are high, all your capital would just leave.
Exactly right. You'd trigger capital flight. But in this environment, this preemptive easing, that whole dynamic flips.
How so?
Well, because there isn't an immediate crisis, that desperate need for safety for high U.S. rates to pull in global money, it diminishes. The dollar tends to weaken because, frankly, U.S. assets might not offer the best risk-adjusted return anymore compared to growth opportunities elsewhere.
Okay, so the money starts looking outwards.
Precisely. Capital flows out of the U.S. into places with potentially higher growth. EM currencies can strengthen. And here's the kicker. Their local central banks suddenly have room to maneuver.
Ah, they can cut their own rates now without sparking that capital flight we talked about.
Yes. It allows them to start or continue their own easing cycles. It's a complete reversal of the crisis playbook. It's potentially huge for EM.
And it's not just the fundamental story, is it? The analysis points to some technical tailwinds kind of pushing things along, too.
Definitely. There are these systematic factors working under the surface. First, you've got volatility targeting portfolios.
Right, the vol targeting funds. For listeners maybe not familiar, what are they actually doing?
They're basically rules-based strategies. Simple concept. If market choppiness or volatility is high, they automatically reduce their risk exposure, they sell.
Okay.
But when volatility is low, like it has been recently, the rules force them to buy. They have to add exposure. It acts like this steady, almost mechanical buying pressure under the market, regardless of day-to-day news.
Got it. And the second technical factor?
Trend followers, often called CTAs, commodity trading advisors. These guys are largely momentum players.
They just follow the trend.
Pretty much. And because the underlying market trend, especially in equities, has stayed pretty strong, their signals are keeping them long, meaning they're betting on prices going higher.
So you have these two big systematic forces, vol managers, buying the calm, trend followers, riding the momentum, both adding stability on top of the Fed's easing signal.
It creates a pretty solid technical floor, yeah.
Okay, before we jump into the assets set to benefit most, there was one specific sort of niche opportunity mentioned that caught my eye. Financing opportunities.
Yeah.
Something about the ghost of the 2024 funding squeeze.
Ah, yes, year-end funding spreads.
Yeah.
Even though the market isn't really stressed right now, those spreads for borrowing cash over the year-end period are still trading, let's say, rich.
Rich meaning expensive. more than they should be.
Exactly. Higher than historical averages, probably higher than fundamentals justify. It seems like the memory of last year's liquidity crunch at year-end is making people cautious. They're pricing in a risk premium that might not actually be needed this time around.
So lingering caution, even with this non-crisis cut.
Seems like it. And that creates this little window, an unusual yield opportunity, particularly for investors who have a lot of cash and aren't super constrained by regulations.
They can lend that cash out at those rich rates.
Right. They can basically capture that elevated yield, exploiting the market's slightly irrational fear based on last year's experience. It's an interesting side effect.
Okay, this is where it gets really juicy. Let's talk beneficiaries. The assets really poised for outperformance because of this strategic easing. We have to start with emerging markets, right? If the dollar weakens and capital flows out, that sounds like rocket fuel for EM stocks.
It absolutely can be, especially because, as we said, it allows their own central banks to ease. The forecasts are pretty clear now. We're likely to see a whole wave of EM central banks cutting rates through 2025, maybe into 2026.
Cheaper money and faster growing economies.
That's the formula. Lower borrowing costs boost businesses, help consumers, and should feed directly into corporate earnings growth for EM companies.
It sounds compelling, theoretically. But I mean, aren't there always risks in EM? Geopolitics, debt levels? Is the optimism maybe overlooking some shaky ground?
That's always the caveat with EM, you're right, sovereign risk is real. But there's an interesting counterpoint noted in the analysis. Even China.
Which has been a big drag on sentiment.
Exactly. Even China is starting to show signs, maybe subtle ones, but signs nonetheless, of a more helpful fiscal and liquidity stance. It's not a game changer on its own, perhaps, but it adds a bit more confidence to that EM bull case. If the capital really starts flowing, that rising tide could lift a lot of boats, at least for a while.
Okay, so EM looks promising. Now, if the dollar is weakening and money is maybe less keen on treasuries, where else to go? The classic answer often involves gold.
Yes, gold. It's been performing well, but the outlook here is, frankly, quite remarkable.
What does history tell us about gold right after the Fed starts cutting?
History is pretty kind to gold in these moments. It often performs best right after that first cut. We've seen periods where it delivered double-digit returns in the, say, 9 months following the initial ease.
Why is that? Lower real yields? Weaker dollar?
Both. The non-crisis cut pushes down real yields. That's the yield after accounting for inflation, which makes a non-yielding asset like gold more attractive. And yes, the weaker dollar helps too, as gold is priced in dollars globally.
And the forecasts we're seeing are, well, they're pretty bold, talking averages near $3,800 by late 2025, potential moves above $4,000 in early 2026.
The numbers are eye-popping, certainly. But there are some structural drivers underpinning this beyond just the immediate rate cut effect.
Like what?
Well, 3 things mainly. First, those nagging stagflation fears the worry about sluggish growth but still sticky prices. Gold loves that environment. Second, just general political uncertainty around the globe. It pushes investors towards perceived safe havens. And third, maybe more fundamentally, there's this growing skepticism about central bank independence, about the long-term stability of fiat currencies. Gold is the age-old hedge against that.
Interesting. We also saw a note that the gold trade is getting crowded. Something about traders flipping the skew. Can you break that down for us?
Sure. Skew refers to the pricing of options. Normally, put options, which protect against a price fall, are more expensive than call options, which bet on a price rise. That's a negative skew reflecting fear.
Okay.
When the skew flips, it means demand for those upside call options has become so intense that calls actually become more expensive than puts. It's a sign of massive bullish conviction, people aggressively chasing the rally. It can sometimes lead to short-term volatility, but it signals strong underlying belief in higher prices.
Got it. So EM, gold, was the third leg of this stool. Miners.
Right, mining stocks. Often overlooked, but they seem to be benefiting from like a triple tailwind right now.
Okay, tailwind 1 is pretty obvious. If EM and global growth pick up, they need more raw materials. Basic stuff.
Basic but powerful. Tailwind 2, though, is newer and potentially revolutionary. AI's appetite.
The demand for minerals to build all this AI infrastructure.
Exactly. Data centers, next-gen computing, it's incredibly mineral intensive. We're talking unprecedented demand for copper, nickel, certain rare earths. The digital future is literally built from stuff dug out of the ground, and miners control the supply.
That makes sense. And the third tailwind.
M&A momentum, mergers and acquisitions. We've seen some big deals already. And the thinking is that moves like the potential tech-Anglo-American combination could spark a whole wave of consolidation in the sector.
Why now, and where specifically?
It seems particularly focused on copper. Bringing new copper supply online is incredibly expensive and takes a very long time. So buying existing assets through M&A becomes more attractive. Consolidation helps companies gain scale, efficiency, and maybe some pricing power in a market facing really strong long-term demand. It's a powerful mix. Global growth, tech demand, and industry reshaping itself.
Now, shifting gears slightly, not everything seems to be following the, let's say, standard playbook for what happens after a rate cut. What are we seeing, or maybe not seeing, in typical sector rotation?
Yeah, this is interesting. Historically, right after the first Fed cut, you often see defensive sectors do well. Think healthcare, utilities, consumer staples.
People getting nervous about growth slowing down, moving to safety.
Exactly. And financials, banks especially, tend to stumble a bit because lower rates can compress their lending margins. That's the typical pattern.
But we're not quite seeing that this time.
Well, the financials part seems to be starting. After a strong run earlier, they are showing some cracks, which fits the pattern. But the defensives, they haven't really rallied as strongly as they typically would have by now.
So what does that relative underperformance suggest?
It could mean there's potential for a significant catch-up move later on, especially if growth does moderate more noticeably heading into 2026, as many expect. It might be a delayed reaction rather than the pattern being completely broken.
Okay, so defensives might be a space to watch for rotation. What about the overall market technicals? S&P 500, NASDAQ near highs. But the analysis flagged the Russell 2000, the small cap index, as a key pivot point. Why the little guys?
Yeah, the Russell 2000 is really important here, maybe more than its market cap would suggest. It's because movements in small caps have this disproportionate impact on hedging flows from structured products.
Structured products, those complex investments. How do they link to the Russell?
A lot of these products, which often involve leverage and options, are linked to the performance of small caps. So, when the Russell 2000 makes a sharp move, up or down, the banks and institutions that sold these products have to buy or sell huge amounts of futures, often S&P 500 or NASDAQ futures, to rebalance their own risk hedges.
So a big swing in the Russell can force massive buying or selling in the broader market.
Precisely. It can amplify volatility way beyond what you'd expect just looking at the small caps themselves. If the Russell were to suddenly reverse course sharply downwards, those hedging flows could pour fuel on the fire, making any sell-off much worse. It's a kind of hidden leverage point in the market structure that we need to keep a close eye on.
Okay, that makes sense. So while we see these opportunities in EM, gold, miners, we absolutely have to talk about the risk. What could derail this whole strategic easing narrative?
I think the number one risk is what you could call the growth trap.
The growth trap.
Yeah. Right now, the market is pricing in this nice, smooth transition. The Fed cuts preemptively, growth slows gently, everything's fine. But what if growth slows down much more sharply than expected?
Like unexpectedly tanks.
Exactly. Maybe something unforeseen happens globally, or credit suddenly tightens. If that happens, the market could instantly reevaluate everything. Suddenly, the Fed's cuts wouldn't look preemptive anymore. They'd look like they were behind the curve, cutting because a crisis was already unfolding.
And that would reverse the whole story.
Completely. The dollar would likely spike, capital would flee back to the U.S., and all that optimism for EM and commodities could evaporate very quickly. That's the biggest downside scenario.
And we still have those structural risks lurking,
Very
like
quick.
the Russell 2000 volatility amplification we just discussed.
Absolutely. That remains a constant background risk. It could turn a minor dip into a major slide if triggered the wrong way.
What about gold? Despite the bullish outlook, it's not immune, is it?
No, definitely not. Gold is still sensitive to shifts in inflation expectations and real yields. If, for some reason, inflation fears really subside quickly, or if real yields were to climb again unexpectedly, gold could definitely take a hit, even with those strong structural supports. No trade is ever risk-free.
And one final risk highlighted was about concentration. Something about leveraged ETFs.
Yeah, the demand for those leveraged single-stock ETFs, the ones that give you double or triple the daily return of a specific stock, seems to be really narrow right now.
Focused on just a few popular names.
Very much so. Mostly concentrated in a handful of big AI players and some crypto-related stocks. Outside of that small group, the interest is apparently quite thin.
And why is that a vulnerability?
Because it creates an air pocket. If the vast majority of speculative money is chasing just a few hot stocks or sectors and those suddenly turn down, the negative impact can be much sharper and spread further than you'd expect. There isn't broad participation cushioning the blow. It's a sign of potentially fragile sentiment concentrated in just a few places.
Okay, so pulling it all together, what's the big picture takeaway? This seemingly small rate cut feels like a genuine turning point, doesn't it? But mainly because the reason for it is different this time.
That's the core of it. Strategic easing, not desperate easing. That shift in context potentially rewrites the playbook for the next 12 months or more.
So for you listening, the key things to watch based on our deep dive seem to be emerging markets, gold, and miners look like the prime beneficiaries of this shift.
Right. Defensives might be due for a rotation, a catch-up trade, and for those positioned correctly, there are potentially some interesting yield opportunities in those year-end financing spreads, thanks to that lingering market caution.
It really feels like the ripple effects from this one move could define global markets for the next year. The key, as always, is probably staying flexible, staying alert.
And remembering that sometimes the biggest, most powerful trends start with the smallest, most expected moves if you understand the subtle shift in the underlying story.
See you all next Pro Ticker Deep Dive.